If you were on the SAVE plan, here's the hard truth. It's gone. Struck down by a federal court in March 2026. And that forbearance you're sitting in, it could be quietly costing you money and forgiveness credit every month. By the end of this video, you'll know exactly what to do. So here's our plan. We'll cover what actually happened to SAVE and the deadlines you're facing, the new RAP plan and how it's different, why your forbearance may be hurting you, when to switch to IBR, the Parent Plus deadline you cannot miss, whether to refinance, and a 5-step plan for the next 60 days. Quick thing. Student loan rules are changing fast in 2026, and getting one deadline wrong can cost you thousands. If this channel helps you stay ahead of that, subscribe. Okay, let's get into it. Your SAVE plan isn't paused, it's dead. And right now, doing nothing is quietly costing you money. Let's start with what actually happened. SAVE launched in 2023 as the most generous income-driven plan ever. Low payments, an interest subsidy, some borrowers paying zero. Then came the lawsuits. On March 10th, 2026, a federal court vacated the SAVE rule entirely. It wasn't reformed, it was eliminated. A separate law, the One Big Beautiful Bill Act, was already phasing it out, but the court ended it early. So where does that leave you? If you were on SAVE, you were placed in an administrative forbearance. Payments paused, but that pause is ending. Starting July 1st, 2026, servicers begin sending formal 90-day notices. Once you get yours, the clock starts. If you don't pick a new plan in time, you'll likely be dropped back onto the standard plan around September 30th, 2026. And that payment can be brutal. Bottom line, SAVE is not coming back. Doing nothing is now a decision, usually a bad one. The $0 payment is gone. Here's the plan replacing SAVE. Is $0 and why it's not the same deal. Now, the replacement, the Repayment Assistance Plan, or RAP, launching July 1st, 2026. It's income-driven, like SAVE, but the math is different and mostly less generous. RAP charges between 1 and 10% of your adjusted gross income, depending on your loan balance, with a $50 reduction per dependent. Here's a key difference. Under SAVE, some people paid zero. Under RAP, there's a minimum payment of $10 a month. No more $0 payments. Forgiveness under RAP comes after 30 years. Compare that to 20 or 25 years on the older income-driven plans. That's a longer road. But RAP does have one real upside. If you make your full on-time payment and it doesn't cover the interest that month, RAP waives the unpaid interest, so your balance won't balloon the way it can on other plans. Make every payment on time, and your balance generally shouldn't grow past where you started. Though this depends on your loan details, so verify your own situation. So RAP is a mixed bag. More predictable on interest, but generally higher monthly payments and a longer timeline to forgiveness than SAVE promised. It is not a one-for-one replacement, and you shouldn't treat it like one. That free break from payments? For a lot of borrowers, it's quietly erasing their forgiveness progress. Here's the part too many people miss. That SAVE forbearance feels like a free break. But for a lot of borrowers, it isn't. Two things are happening. First, on most loans, interest is still accruing during the forbearance. You're not paying, but the balance can keep growing in the background. Second, and this is huge if you're going for public service loan forgiveness, months spent in this forbearance generally do not count toward your PSLF total. So if you're a teacher, a nurse, a government worker counting on forgiveness after 120 payments, every month you sit idle in SAVE forbearance is potentially a month of zero progress. There is some good news. Borrowers pursuing PSLF may be able to buy back certain months later. But that's a process, not a guarantee, and it's not automatic. The takeaway is simple. If you're chasing forgiveness, staying parked in forbearance is often the worst place to be. You want qualifying payments counting again, as soon as possible. If you're chasing PSLF, sitting still is the worst move you can make. Here's where to go instead. So if SAVE is gone and RAP isn't here until July, what do you do right now? For a lot of borrowers, the answer is IBR, income-based repayment. IBR is available today. Your qualifying payment history carries over. You do not lose your progress toward forgiveness by switching. And critically, IBR payments generally count toward PSLF when you meet the program's requirements. Unlike sitting in forbearance. Here's a nuance worth knowing. If you might want to move to RAP later, some experts suggest PAYE as the in-between, because leaving IBR can capitalize your interest, meaning unpaid interest gets added to your principal. Pay can avoid that in a future switch. But pay is being phased out for new enrollments, so this is situation specific. For most people who just need to get out of forbearance and keep forgiveness progress alive, IBR is a solid, available choice. you can stay on it indefinitely. There's no forced move to RAP. How to do it. Log into StudentAid.gov. Use the loan simulator to compare plans against your real numbers that apply to change your repayment plan. Don't guess. Run your own figures. If you have Parent Plus loans, a June 30th deadline may already be deciding your options. Check this now. Now, if you have Parent Plus loans, this section is the most urgent thing in the entire video. Pause and pay attention. Parent Plus loans are not eligible for income-driven repayment on their own. The only way in is to consolidate them into a direct consolidation loan, which unlocks ICR, and from there, you can move to IBR. Here's the deadline. Your consolidation loan must be fully dispersed by June 30th, 2026. Not applied for, dispersed. After that date, the door closes. Parent Plus loans consolidated on or after July 1st cannot enter ICR, IBR, or any income-driven plan. And RAP excludes Parent Plus entirely. That would leave you with the standard plan only, and no realistic path to PSLF. Now the scary part, consolidation can take anywhere from 30 to 90 days to process. We are already in June. If you have not started, you are dangerously close to the edge, and possibly past the safe window. One more warning. If you take out even one new Parent Plus loan after July 1st, it can drag all your existing Parent Plus loans into the new structure and wipe out your income-driven access. If this is you, talk to your servicer today, not next week. Refinancing can drop your rate, but you give up federal protections forever. Here's the honest math. Let's talk refinancing, because with federal protection shrinking, more people are asking about it. Here's the honest math. When you refinance federal loans with a private lender, you may get a lower interest rate and a lower total cost. But you permanently give up everything federal income-driven plans, PSLF, federal forgiveness, and federal deferment and forbearance options. That trade is forever. You can't undo it. So who might refinancing make sense for? Generally, borrowers with a secure, high income, strong credit, no intention of using PSLF or income-driven forgiveness, who just want the lowest cost and fastest payoff. For that person, a lower private rate can sometimes beat RAP's longer, more expensive timeline. But run your own numbers. Who should probably not refinance? Anyone pursuing PSLF. Anyone who might need income-based payments if their income drops. Anyone whose job or income feels uncertain. Once you refinance away your federal status, those safety nets are gone. This isn't financial advice, and I'm not a financial advisor. Your situation is specific. Run the numbers both ways before you commit, and remember the federal protections you'd be giving up have real value, even if they're less generous than they used to be. 5 steps in the next 60 days take you from exposed to in control. Let's run through them, okay? Let's turn all of this into a clear 5-step plan for the next 60 days. Step 1. Log into StudentAid.gov and confirm your current status. What loans do you have? What plan are you on? And are you in that save forbearance? You can't plan until you know where you stand. Step 2. If you have Parent Plus loans and any chance you'll want income-driven repayment or PSLF, start consolidation immediately. June 30th is the disbursement deadline and processing takes weeks. This is step 1 for you today. Step 3. Run the loan simulator. Compare IBR and RAP once it opens against your actual income and family size. Don't rely on rumors. Use your real numbers. Step 4. If you're pursuing PSLF, get out of idle forbearance and onto a qualifying plan like IBR so your months start counting again. Step 5. Only if federal forgiveness truly isn't part of your plan. Price out refinancing as a comparison, knowing what you'd give up. Do these 5 in order, and you go from exposed to in control. Here's the one thing to remember. Save is over, and waiting is now the most expensive option. The borrowers who act in the next 60 days, check their status, hit the Parent Plus deadline, get onto the right plan, those are the ones who stay in control. This is a setback, not the end of your options. If this helped you, subscribe. I break down real money situations like this every single week. Drop your question in the comments. I read all of them. And if you want to know exactly how to navigate these student loan changes, that video is right here. See you next week.